Following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it's Saturday, and we are talking about money here on The Answer. So, in the past, I sent out a newsletter. It's been a few weeks ago. Sent out a newsletter, and I've been reflecting on a question that a prospect wrote back and said, why do you compare yourself to beating the S&P 500? On every contract that we sign, on every new client account that we open, we say we have a desire to outperform the Standard & Poor's 500 with dividends reinvested. And the person that sent in the question said, why do you pick the Standard & Poor's 500? Why do you talk about beating any index? And so I've reflected on that for a couple of weeks, and I think I want to respond to that and respond to that here on the radio, because advisors and gurus in my industry say that's a very bad goal, to try to beat the Standard & Poor's 500. The idea for most financial advisors is to reduce expectations, to convince their clients that you cannot beat the Standard & Poor's 500. And so why try? Well, we have a passion for creating wealth. And yes, we have a track record actually of beating the Standard & Poor's 500 over the longer term, over the 16 years that I've been in business as Adams Financial Concepts. In fact, longer than that, but there's no way to show when I was at the big firms that I was doing it there either. So why does it all roll around? And let me divert just a second. Ever think about playing Russian roulette? It seems like a strange question, maybe. You know, where you have a revolver with 6 bullet chambers, and you put one bullet in one chamber, hold it to your head, spin the whatever it is, spin that around, and then pull the trigger, and you have 5 out of 6 chances that you will live, but 1 chance out of 6 you won't. Think about that, and I'm going to give you a reason why I raised that question. Think about a second thing. Throwing dice, two dice. Throw dice, and you bet your entire life on the number 8 coming up. You don't win if there's a 7. You don't win if it's snake eyes. You don't win if it's 2 6s. You don't win if it's any other number but 8. So here, let me tell you how it applies. You know, I've seen a financial advisor put down a diagram where they draw a box, and then they draw one string holding the box up, and they say this is like an elevator. And this one cable holds your elevator, and it moves you up and down the floors. Wouldn't it be better to have 4 cables that move you up and down the floor? You know, and they try to explain the elevator as being asset allocation. That's supposed to keep you safe. Well, let me tell you about Russian roulette and the dice, because statistics show that you and I and everyone in the United States has a 40% chance of getting cancer. And most cancer is curable. Most cancer is treatable. And any number of people have faced cancer and have gotten through it. But 1 out of 3 cancer patients depletes their entire savings. 1 out of 3. Though a lot of the people that deplete their savings have financial plans, which said that it would take them through retirement and through the remainder of their life. 1 out of 3 cancer patients will deplete all their savings because of medical costs. 1 out of 3 will end up very often filing bankruptcy. So what does that have to do with Russian roulette? What does that have to do with throwing 2 days? Because the chances of that happening are 12%. 1 out of 3 is 1/3, and 1/3 of 40% is 12%. The odds of throwing an 8 on a pair of dice is 13%. The odds of firing a bullet into your head with playing Russian roulette is about 17 or 18%. But that's the kind of focus that people have, or that's the kind of risk that people have playing with their health. But that's only with your health. And nobody has a goal of getting through that they want to get cancer, but yet that is one of the things which we're exposed to. No one wants to get COVID either. So how does it work when you add a 3-ton weight to the elevator? You're not talking about just another person stepping in. You're not talking about 4 cables. You're talking about sticking a 3-ton weight into the elevator. Even with 4 cables, that elevator plunges down. And it's not just cancer. I use that as an example, but it's other catastrophes as well. It could be hit by a drunk driver who has no insurance. It could be a flood. It could be a tornado or weather. It could be a pandemic. It could be any number of things that happen. You know, that's part of our thinking behind why we want to have our clients have a quality of life, which any of those events will not shake away and will not ruin their quality of life and will not keep them from living a good life without filing bankruptcy. It's the goal to give you enough. But when we set a goal, we want it to be a measurable goal, and we want it to be clear, and we want to know whether we're meeting it or not meeting it. That's why we chose the Standard & Poor's 500. And there's some 13 million indices, 13 million that have been developed over the last years to help explain why this mutual fund in this specific niche doesn't or does meet the benchmark. The Standard & Poor's has been around. It's clear. People have seen it since the 1920s. They know what it is. They know how it is. And it's very difficult to achieve. Eugene Fama and French got the Nobel Prize, or shared the Nobel Prize in 2013, showing fewer than 3 or 4% of all money managers can actually beat it, and fewer than 1% beat it by as much as we do. It's a really difficult thing to focus on, and I believe that that's the real reason why the gurus and the financial advisors and the centers of influence talk about lower the expectations, and there's been books that have been written about it. Charles Ellis wrote a book called, and I don't remember the name of the book, that's terrible to say, but the whole focus of the book was lower your client expectations. Make them think that if they're doing okay, they're doing okay and they'll be fine. We don't think that. We think we want to do very well. We want to maintain quality of life. The newsletter that I wrote looked at how clients were doing in the largest 100 firms in the RIA space, the Registered Investment Advisor space. The top 100 firms, those are the top rated by the number of assets that they're managing. Some are managing $8 and $9 and $12 billion, ranked by number of assets. How have they done? So Financial Advisor magazine produces a list of the top 100, and in fact, they're top 150 firms, or 1,500 firms. Top 500 firms. I'll get it right one of these times. They look at the top 500 firms, and they look at how the firms are growing. They're looking at their total assets. They're looking at the growth of the firm from the previous year, and they look at the client asset growth. How much are the assets in client accounts growing? And I looked at that, and every year I look at it, and every year I see exactly the same thing, almost the same thing. And if you look at the top 100 firms, their return for their clients in 2020 was only 3.7%. 3.7. The market's up 16%. Clients in the top 100 firms averaged only 3.7%. That's the growth of those firms, on the other hand, was close to 20%. They're growing faster, but they're doing the growth by acquiring new clients or buying other firms. Their focus is not on their clients and building client wealth. Their focus is building on firm wealth. If you look at how we did in 2020, we were up 77% for our clients, and our firm growth was up 83%. It's almost the flip of what we see in the top 100 firms. And if I look at the biggest Washington firms, if I look at Brighton Jones, which ranked 47 on that list, the firm grew by 24%. Their clients grew by 6%. There is a question about what the focus is for the firms in my industry. Are they focused on their internal growth, growing the firm itself, or are they focused on their clients? Our focus is on our clients, 100% on our clients. When our clients do well, we do well. But our focus is on our clients and has been and will continue to be. So don't go away. We're going to come back and talk about other things. We've got a lot to cover.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
I'm picking up where I left off from the break. I had sent out a newsletter. The newsletter said that every contract that we signed with our clients had a focus and a target of trying to outperform, do better than the Standard & Poor's 500 with dividends reinvested. And a prospect broke in and said, why? And I started to go through it. I want to continue along that way because I want to talk about what's going on in my industry and the impact of that. I talked about the top 100 firms, measured by the amount of assets they manage, and they manage billions of dollars, billions and billions of dollars. But the focus on those firms, they're averaging almost a 20% per year growth, the top 100 in terms of assets managed, in terms of investments managed. They're averaging a 20% growth in 2020. But their client accounts are growing by only 3.7%. I find that horrible. But we're going through a time in this industry when I think there's going to be kind of a shakeout happening. We want a clear and measurable goal. We want a niche where our focus is and our passion is creating and maintaining wealth for our clients. And so we want a goal. We want to know whether we do or don't meet that goal, and our goal has been the Standard & Poor's 500. And why? It comes back to the question of compounding. If you look at a $500,000 account and you are increasing the account about 5% per year, which is about the average for financial advisors, a number of studies have shown about 5% per year. If you grow that $500,000 at 5% over 25 years, you end up with tripling your money. You end up with $1.5 million, which seems like a really nice deal. But if you take that same $500,000 over 25 years and do 15%, and we're actually since the Great Recession, we are doing almost 20%. And if you look at the formation going through the Great Recession, we're doing almost 15% a year. So if you look at that over 25 years, not 1.5 million, but 16 million, more than 10 times, just that difference between 5 and 15%. Our focus is our passion is on creating wealth. And so who do you think has the better chance of living through life's storms? We feel that we have a much stronger approach than most financial advisory firms. I want to tell you about a case study. I want to tell you about a client that came to us in August of 2000. She'd gone through a divorce. She had fibromyalgia. She had Lyme disease. She had a total investable assets of $911,000. In the divorce, she ended up with one of the two houses they had, and she had a mortgage payment on that house. She had significant medical expenses. She'd been to two financial advisors, two financial planners, who had said, and this client was just 53 years old with all these issues. The financial planner said, if you continue to pay what you need to pay for your medical and your living and your mortgage and so on, you'll run out of money by the time you're 72. 19 years, you'll be out of money. And it wasn't just one financial planner that did that. She'd been to a couple financial planners, at least two that I know of. And so when she came to me, she said, this is my situation. I really don't want to run out of money. I said, let's sit down and see what we can do. I think that I can keep you from running out of money. So that was in August of 2000. And you know what was going on in the market in 2000? The market was crashing because of the dot-com bust. It was not a pretty time to invest. It was not a good time to invest. But she needed, out of that $911,000, she needed $5,000 a month, $60,000 a year. Now, most financial planners will tell you that taking 4%, which would be 4% was just $3,000 a month. If you try to exceed 4% a month, you won't run out of money. She needed 6%. I said, I think I can do that. I've been doing that for a long time, taking out even more. And that's where we began, August of 2000. We began that time. I'm sad to say that she did pass away in 2018, but at the time she passed away in 2018, she'd taken over $1.5 million out of that account, and she had essentially the same amount of money that she started with, very close to the same amount of money that she started with, close to the $911,000. That's the difference between focusing on the financial plan with all those cables holding the elevator and focusing on a target of beating the Standard & Poor's 500. So, which brings me to another question. What's going on in my industry? But because there's a general consensus you can't beat the market, you have to lower expectations. That's something that pervades my industry. When I started out, I licensed in June of 1986. We were traditional stockbrokers. We were making money by transaction, buying and selling stocks, stock jockeys kind of things. When I started out, the idea was if you couldn't make money for your clients, they would move their account to somewhere else. And people moved their accounts a lot. Almost 20% was the average in those days. Move it far less these days. But that's where I came from. And I've seen an evolution taking place. It's what some people have called the Vanguard argument. Vanguard, the mutual fund, and Jack Bogle, the late Jack Bogle, came out with the idea that since you can't beat the market, the best you can do is invest in an index fund. And by investing in an index fund, you get almost market returns, and you get very close to performing almost like the market. Since you can't beat it, you get as close as you can, and that's by investing in an index fund. And the idea was to do a low-cost beta, alpha. Alpha is the excess return from any given stock. So if you factor out, if the market is going up There's an old saying that a rising tide lifts all boats. Same thing in the stock market. When the market is going up, it tends to lift all stock prices. When it's going down, it tends to decrease all stock prices. Alpha is the part of a company's stock, or the value of the stock, according to modern portfolio theory, where that's the excess that's due to the company in whose stock that you own. Maybe that sounds a little complicated. All I'm going to say is, if you take the influence of the market out, what you're left with when the stock is up or down is the alpha. And what Vanguard argument was is you can't really get an alpha that increases over the market. So you might as well just look at reducing your fees to a low-cost beta. That was the Vanguard argument. And they sold a ton of index funds. There are huge numbers of index funds. And what happened as well is financial advisors began to buy into the Vanguard argument. And it's become, in my industry, a race to what's called a race to zero, because fees continue to tumble down and down and down. For Adams Financial Concepts, we lay it out there. We charge 2% for the first $2 million and 1.75% for assets over $2 million. We also do a profit sharing account, which we share the profits 20/80 with no fee. Our fees are non-negotiable. That's what we've been paying. But if you look at what's going on in my industry, there's been a race to zero. I've heard that 20% I've heard that new accounts, the fees that are being charged are 20% lower than existing clients. To me, if I lower fees for new clients, it seems to me that I'm not being fair to the clients who have been with me for a lot longer time. So the question is, how are financial advisors doing? And I believe that there's going to be a shakeout in our industry because we have robo-advisors coming along. We have this race to zero with fees getting cut. And there are some now that are trying to raise their fees some. But when it all boils down and when you only distinguish yourself by the fee that you charge, and when clients come in and want to negotiate fees and advisors do that, the race is the race to zero. And you have to cut some of your services out as soon as you start reducing your fees. You can't provide the same services with lower and lower fees. We're going to come back to this whole topic and finish up because it's important to understand. I believe that there's something going on in our industry which is going to be a shakeout, and many of the people that are listening to this program are going to find that their advisor is either out of business or is sold out to somebody else. And if you're sold into one of those top 100 firms, your returns are probably going to be around 3.5% to 5%. Not the best, in my opinion. Hang on, we'll be back. A lot more to cover, so don't go away. We're going to be right back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So, I once had a client who was a travel agent. This goes back to the early 90s. And I can remember talking to him about the internet and the internet was new at that time. It was just coming into being. A few people had emails, but not everybody had emails. And I said to him, don't you think, as things began to happen in the travel industry, I said, don't you think there's going to be an impact for travel agents? And he said, no, because people are always going to need a travel agent. Planning trips is really, really pretty specialized. And so travel agents are always going to be around. Well, you know what happened in the travel industry. Used to be walking to a mall in the 90s, there were 6 or 8 or 10 travel agents. Every street corner had a travel agent. Today, it's hard to find travel agents. They're around, and those who have survived have done well, but most are gone. And I believe that that's about to happen to my industry because fees continue to shrink. There continues to be fee compression. There is a race to zero, and robo-advisors are now providing almost the same service as human financial advisors, and robo-advisors are doing it for 0.2% or 0.1%, whereas advisors are providing those services at a full percentage point. There's a race to zero. And so as I look at it, I think there's going to be 3 things that happen. There are going to be firms that get in front of this. They're out in front. They understand the changes that are going on. I believe that the great majority will go with the flow. And there's going to be a lot of firms that just get left behind. Our focus at Adams Financial Concepts is to be out in front. We're not like the other financial advisors who are doing financial planning and doing all those services. I believe that most of those will be going with the flow, but I believe there are some financial advisors who focus on estate planning and complicated affairs. The family offices, they're dealing with taxes, they're dealing with the whole question of what happens to an estate, a second and third and fourth and fifth generation. I believe that specialty will continue to thrive because they're very specialist type financial advisors. But for most financial advisors, they're living with the race to zero. They're living with lowering their fees to get in new business. And remember, I talked in this program about the biggest firms in our space, the biggest RIA, Registered Investment Advisor firms managing billions of dollars. They're growing at 20% per year in 2020, but their clients are only growing at less than 4%. They're focusing, they're buying other firms, they're bringing in new clients, but they are in a squeeze. And the more things get squeezed down, the fewer the services they can provide. And I know, looking at what's going on in the industry, 60% of the firms in my industry, the costs are increasing faster than the revenue growth. So the option is to cut service or to cut bait and go somewhere else. Those are the firms that are going to go with the flow until their revenues are at such a point that they can't cover all the cost, and then they're going to go away. There are those firms that can't even make those adjustments, and those will be the first ones to go. They are going now. They are the firms that are selling their books and moving on. That's where they are with the whole thing. For us, we just added 3 new advisors, Al Souza, Christiane, and Jen Winans. We're focused on our clients. We're focused on being there 24/7. There's the Fisher ads, the Ken Fisher ads that talk about 2 things. We only make money when you make money. We only make more when you make more. And we're fiduciaries. Well, the fact is, we're in the same boat. We're fiduciaries, and we only make money when our clients make money. And we only make more when our clients do better. But there was one thing left out of those Fisher ads. Those are 2 points. only making money when your clients make money and being a fiduciary. But the thing left out is not being there for the clients. Our focus with our advisors, which include Al, Chris, Jen, and myself, is to be there for our clients 24/7. Not just a phone call, not just holding hands, but there for financial security. We don't want our clients to put their livelihood or their nest egg and see it disappear on a roll of the dice, see it disappear in a Russian roulette, see it disappear. I started the program by talking about 40% of people will have cancer, and 1 out of 3 of those will lose everything. We don't want our clients to be in that situation. We detest that situation. So that's where we're coming from. That's what we want to do. I'm 78 years old. I've been in the business for 35 years, going on 36 years now. And while I'm the chief investment advisor, that's moving along. And over the next 8 to 10 years, and I do plan to be around 8 to 10 years, a lot of that knowledge of what I've done is going to pass to the 3 young advisors, Al, Chris, and Jen. And we work as a team. They're going to be part of it. Al is 50 years old. Chris and Jen are in their mid-20s. They bring to the table a knowledge of what's going on technology-wise that even goes beyond what I understand. Al understands the changes that are happening in demographics, and our focus is to be ahead of the curve, to be in front of what's going on rather than reacting to today. We want to be proactive and be out in front. We want to know where we're going. And we look at changes in technology, changes in demographics, changes in lifestyles. And those are changing and impacting what's happening in our world. And as we emerge from COVID, as we come out of this whole thing, I believe that COVID could be the Pearl Harbor moment of our lifetime. Think about it. Pearl Harbor was the launch of World War II. But World War II, there were tremendous advances made. There was a lot of the big cannons that were moved around, especially on the German side and the Italian side. They actually used horses to move those big cannons around. You had rooms full of people who would actually sit down and calculate how to aim those guns, take into consideration what the weather was like, what the winds were like, what the distance was. And with all that information, they would sit there and calculate how to aim the guns to hit the target. Those are people sitting in a room, and they went to a company and asked the company, can you make a machine to do this? And the company said yes, they could make it. They thought they could make a machine, and the rumor is they thought that the worldwide market for such a machine was probably only 4 or 5 machines total. Well, the name of those people in that room that were doing those calculations, their job title was human computer. And of course, now we know what happened. They didn't sell 4 or 5 machines. They sold 4 or 5 machines to everybody who exists today. Well, not quite, but that was a World War II moment. You think of the Manhattan Project, developing the atomic bomb, understanding how that all works. One of the cures of cancer, one of the things that's used in cancer is nuclear medicine. That came from work that was done to develop the atomic bomb. We talk about going green and building nuclear plants. All of that is something that was launched in World War II with the atomic bomb. That's an area. That was the Pearl Harbor moment. That was the time. Think about the change. We had penicillin was extremely difficult, and it was during World War II that Pfizer actually came up with how to make penicillin on a massive basis. They needed it for the soldiers in the war. Penicillin grew, and a pharmaceutical industry grew out of that as well. So many things came from World War II, and I believe we're on the verge of another massive increase in technology, changes to our lifestyle, changes in demographics. Pearl Harbor moment could be what COVID is right now. And we want to be in front of that, not behind it. We don't want to go with the flow. We want to be way in front, and we want our clients to be way in front of what's happening. That's where we are. We're coming again to a commercial break. Don't go away. We want to finish this with a segment and talk about some of the things that may be going on and the future. So don't go away. And if you miss any part of this program or any of their programs, you can find us on YouTube by searching for About Money. You can also find our podcast on our website. And if you'd like to sign up for our newsletter, just go to our website, log in, and put down your contact information. Please do that. If you'd like to like us on Facebook, check us on LinkedIn. We're all there.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So to wrap up today, I want to talk about some of Peter Diamandis' what he calls Peter's Law. I think they really apply. I think that really fits what we're doing at Adams Financial Concepts, and I think you should understand that. His law is that if anything can go wrong, fix it. To heck with Murphy, and maybe didn't use to heck with, but if anything can go wrong, we do try to fix it. Things do go wrong. The things that have never happened before happen all the time. We've done newsletters and seminars on if it can go wrong, it can go wrong. Things that have never happened before happen all the time. When they happen, you have to be ready to fix it. And we want to be ahead of it so that if things happen that are unexpected, like a pandemic, our clients have sufficient resources to go through it without changing their quality of life. The second law is when given a choice, take both. I like that. It's not either or, it's both. It's not which one do, we take both. His third law is multiple projects lead to multiple successes. And we do. We look at multiple things all the way through. We look at multiple stocks. We look at different ways to organize the business. We look at different approaches to what we're doing in terms of marketing. We look at different things in terms of finances. Multiple projects lead to multiple successes. His fourth law is start at the top, then work your way up. And when we choose to target and want to grow our clients' assets and beat the Standard & Poor's 500, and that becomes our target, that is the top. But each year we want to do a little better. And sometimes we do, sometimes we don't. But at least that's where we're headed. His fifth law, do it by the book, but be the author. We are in the process of transferring knowledge from what I've been doing for 36 years to Al, Jen, and Chris. We are writing the book, and we intend to continue to write the book, and we will do it, I believe, for decades to come. And his sixth law is when forced to compromise, ask for more. I think that's pretty straightforward. There are times when we don't get everything we want, but we just need to ask for more. His seventh rule is if you can't win, change the rules. What we've been looking at when people say that we can't do what we do, we actually do it on a normal time. 8, if you can't change the rules, then ignore them. And sometimes we just have to do that. 9, perfection is not optional. And that's where we want to be. We try to strive as close to perfection as we can get. 10, when faced without a challenge, make one. You know, we don't want to get old and lazy. We want to be sure that there's always a challenge out there and there's always something to do. 11th law. No simply means begin one level higher. You know, when you reach a point where you get stymied, just continue to put your head down and continue to work. 12. Don't walk when you can run. That's our philosophy. We want to be out there and running as hard as we can. Rule 13 was, when in doubt, think. Nothing could be better. When there's a doubt, you have to think, you have to rationalize, you have to analyze, you have to think it through. It's just something that we have to do. 14, patience is a virtue, but persistence to the point of success is a blessing. And it is. We're patient with a lot of things that we do. We're patient with the stocks. You make money in the market not by doing a lot, almost by sitting, watching paint dry. But it's persistence, and it's persistence to the point of success. 15, the squeaky wheel gets replaced. And yeah, if there's an issue, we get it taken care of. 16, the faster you move, the slower time passes, the longer you live. You know what? I'm 78. I feel like I'm just now approaching middle age. I love what I do, and I do it very well. And I put in a lot of hours in everything I do. It's the faster you move, the slower time passes, and the longer you live. 17, the best way to predict the future is to create it yourself. And if you've been listening to my radio program for many years, and it has been going for many years, we've been going since 2008, you know that we set up our goals, we set up what we want to do, and you know that our focus is on what's coming and anticipating the future and creating our own future. 18, the ratio of something to nothing is infinite. Essentially, that means if you do nothing, there's nothing to be gained. 19, you get what you incentivize. You know, the fact is, we want everybody in the firm to do well, and we give them incentives to make sure they do well. We also incent our clients by how we perform. 20, if you think it's impossible, then it's for you. And we've been doing that. All the people that say it's impossible to beat the market, we've been doing it for 16 years. And that's only the years that we have record for. We can't go back to the 18 years that I spent for big firms because they wouldn't allow you to keep track of your returns, although I did. But there's no way to verify it, although there are a few clients that can testify to it. You know, it was supposed to be impossible. I didn't believe that from the beginning, and we have done better than the market. 21, an expert is someone who can tell you exactly how something cannot be done. Relates right back to the previous rule. People said it can't be done to beat the market, but we've been doing it. At the end of 2020, we had 111 stock accounts, clients that people had stocks in. Of those 112, 111 had beaten the Standard & Poor's 500. So it wasn't an average in the composite where one account is pulling all the others out. All those accounts were above the Standard & Poor's 500, with the exception of one which had some bonds which dragged down the performance. Now, as we got into 2021, we may be a little closer to not making it, But this, we could be there anyway. 22, the day before something is a breakthrough, it's a crazy idea. What we're doing, a lot of people said it's a crazy idea, but we've done it. 23, if it was easy, it would have been done already. Yes, so true. 24, without a target, you'll miss it every time. Beginning. That's why our target is the Standard & Poor's 500. We have a target, and we know if we hit it. 25, fail early, fail often, fail forward, and we don't want to fail. But if we don't make things, when things don't work out, we'll try something and continue on. 26, if you can't measure it, you can't improve it. Standard & Poor's 500, that's our target. We want to hit it. We want to improve. That wraps up the show for today. I hope you got greater insight into this industry and what's going on. Join me next Saturday when we will talk about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.